talk about investing in stocks. So yesterday I talked about my view on the macro arguments for gold. Today I wanted to be a bit more specific and talk about positioning in a bull market. I have that as the headline, take off your blinders. I didn't mean that in any sort of derogatory way, but it is very easy to get focused on either specific stories that you like, certain stocks that really catch your attention, or particular kinds of stories that you really like, whether it's maybe you love that, you just had a buyout from Kaminak and you really like that near-term development or near production story, the M&A possibility, and so you're really focused on those. Those are great, and it's good to know what you like and what you're comfortable with when it comes to these kinds of investments. But we're looking, in my view, at a pretty significant bull run ahead. And that bull run, the portfolios that will do the best will contain a wide range of opportunities. So I just wanted to go through today a little bit about the kinds of opportunities that you want to make sure you include in your portfolio for the next little while. So some of these categories we're very familiar with, and I won't spend a lot of time on them, more to highlight the pros and cons of each. So obviously we've got major producers, and we've seen major producers, gold producers, take off in the last few months, doubles for sure, triples even for some of them, which has been quite surprising but wonderful. Certainly the most prescient points there are that they spent the bear market cutting costs. So now they are actually positioned to make a fair bit of money per ounce. So that's really great, and that's the main attraction there. The other more important reason I think that they react so significantly when the market turns is that they're sort of the most major gold producers, or the most straightforward way to gain exposure to a rising gold price. And not only are they the most straightforward, but they are the only eligible way to gain exposure for quite a few major investment groups out there. You're talking about indexes, funds, and ETFs. So those types of investors pour into these large producers because, especially at the beginning of the market, when lots of stocks are still very cheap, those are not candidates for those kinds of investors. So this is part of what drives these producers to rise so dramatically right at the beginning. The gains are certainly not over with these major producers. I know this comparison chart for Kinross is exactly what I showed yesterday. On the one side, we have 160% gain year to date, and on the other side, we have the 10-year chart that shows you've still got a lot of good room to move there. Another argument for major producers is, of course, lots of them pay dividends, so that's great, especially in the world of mining and exploration, where dividends are not exactly a common characteristic. Of course, the difficult part with major producers is debt. They did their best in the bear market to pay off debt, but many of them still have pretty high debt loads, and therefore their growth potential over the next little while, their ability to either buy assets or buy companies, or even expand assets that they have, or build projects that look good into mines, that capacity is somewhat limited because their debt loads are high. And that is the main reason, I would say, that mid-tier producers are so attractive to investors right now. So they have quite a few of the same bonuses that the majors had, which is they spent the bear market cutting costs, so they're primed for some good profitability right now. But within that, they generally have managed their debt loads. Some of them are debt-free, or they have very manageable debt loads. In general, because they have fewer operations, their cost structures are often easier to keep contained. Like, think alone about perhaps legal costs. If you just have one mining operation in Canada, or maybe two in Canada, versus having mines scattered in jurisdictions around the world, legal costs alone would be far more dramatic for that multi-asset operator than for the Canadian-focused one, right? So this is the kind of reason that mid-tiers can keep their costs a little bit more contained. And then it's this the growth side of things, right? Mid-tiers have, with their lack of debt, their cash flow right now, they're able to act on M&A opportunities. And I would say the outlook is the gains to date are as good or better, and the outlook is also as good or better for these mid-tiers. Eldorado would be one good example. We've seen more than 100% gain in Eldorado so far this year, but if they were to regain their heights of 2011, we'd get almost a threefold gain from here, which is a pretty phenomenal idea in itself. But in addition, this is the kind of company that has the ability to be, that has been proactive and has the ability to perform perhaps better in the coming market because of moves that they've made. So for example, they took a stake in Integra. This is a company that has a history of growth through acquisitions, so you can be sure that they're looking at those kinds of opportunities. I'd say New Gold, another good example, up 130% already. A gain to the 2011 peak would be another 130%, which is great, I'd take that. But in addition, they have a very strong production growth profile. They're building a massive mine at Rainy River. They're good to go building that mine that's going to add 300,000 ounces a year of production. So this is the type of thing that a mid-tier that has not struggled so terribly with debt is now able to offer that some of the majors are struggling with. Then we have the developers and new producers. There's not a lot of any of them left. We've heard that refrain a few times yesterday and today. Both those who have near development projects and those who have either under construction or new mines, they're all acquisition targets, absolutely, because these majors and mid-tiers, especially the mid-tiers that I was saying, are able to act on these kinds of opportunities right now, need to restock their pipelines. So new producers, they got it done despite it all, and they're now getting credit for that. Quite a few, in the context of a bear market, built mines that were contained cost-wise and size-wise, but set themselves up to be able to expand without too much extra expenditure. So they've got that extra upside leverage to gold. And that's if they're not acquired, which would be a nice upside for investors. So Rox Gold would be a good example of that. And then, excuse me. Then there are the near developers. Again, only a few projects managed to keep their momentum through the bear market. And at the end of the day here, what we're talking about is the straightforward projects, so not really complicated engineering or complicated jurisdictions or tons of infrastructure requirements, but straightforward projects that offer good economics in supportive, permittable jurisdictions. They're going to get built or bought. So those are obviously a nice group to have exposure to. And the share price movements to date of those three up alone certainly show you that investors are very aware of this kind of opportunity. It took a little while. The bull market had to certainly prove that it was established, but now we have explorers also giving us good gains, which is very nice for a lot of the companies here and the investors here, because it's a really exciting part of the investment game is these explorers. Because they're certainly the highest risk. The whole concept might be wrong, but the rewards can be very significant. What matters when you're talking about what you want to call drill plays is understanding your personal necessary level of confidence. So are you okay with buying before there's been any drilling when it's maybe perhaps simply a geophysical concept? You might be, or you might not be comfortable with that. Are you more comfortable once one drill has hit? Or would you rather wait until there's been follow-up drilling that has proven some sort of scalability for the discovery? There's no correct answer to that. It's a personal answer. But if you're somewhat familiar with your level of confidence there, then you know where you're willing to enter these plays. Of course, the reward potential goes down slightly as the project progresses, but the risk goes down with it. And it's nice to see that investors are moving on all stages of exploration projects today. The companies that I have up on the slide there, Precipitate and Orin and Gold Standard and West Red Lake, they're all somewhat different stages of exploration, but they've all been performing very nicely recently. Okay, so those are the easy ones to think of, like explorers, developers, producers. But there's other business models that you don't want to forget about. So project generators, we've heard from a few already this weekend. The main arguments for project generators are the sustainability of the business model. This is about using other people's money. That's the phrase that we always use for them. Other companies as joint venture partners using their money to advance your assets, which just creates which very much lowers the dilution risk for you as a shareholder. A large portfolio. I know when Greg was up here for Millrock, he talked to this quite with good clarity. The more drilling you do on the more targets, the better your chance of making a discovery in this, low success rate industry. So that's something that a project generator offers to you. And technical strength, I would say, not to decry the geologic expertise of other kinds of companies, but there are a lot of very good geologists who get drawn to the early stage excitement of project generators. So quite a few of them offer very strong technical teams, and the bear market really gave these companies an opportunity to expand their portfolios and like add all kinds of very good assets. So they're very primed to do well in the next bull run because they were able to specifically, their business models were sort of specifically structured to take advantage of a bear market. Questions to ask when you're looking at project generators, I would say the first is, what expertise? So you need a prospect generator that is perhaps jurisdictionally focused. So maybe they are very good in the Americas, or you want a prospect generator whose technical team has a specific area that they're good at, or you want a network, a history that has led them to specific areas. So it's not just a scattershot, we picked up some projects so that we can go out to the market and talk about how big our portfolio is. So there needs to be a specific kind of expertise. Who the partners are is also important. Being partnered with a bunch of tiny juniors is not as good or effective as being partnered with some significant size companies that actually have money to spend advancing your assets. And then what is the game plan? What is there? Do they try to keep stakes in projects? Do they try to generate royalties? Will they ever hold on to a project if it looks fantastic? And is that okay with you? If they do, Kamenak was a project generator until they found coffee. So these are just things to be aware of. Then there's the royalty and streaming business model. Clearly, this is a profit-oriented business model. So those of you who would like to add some dividends to your portfolio from a mining sector, this is another option for that. Not all of them offer, but certainly that's the goal for these kinds of companies. And the other big thing that you get here is project diversity. So you're getting streams and royalties from a huge number of projects. So even if one of those projects fails completely, you're very much buffered from that risk taking the company down as a whole. So Royal Gold had a stream on Rubicon's project. Clearly that did not work out. Royal Gold's share price paid the price, but it has since recovered completely because it's a diversified portfolio with lots of other projects adding value. Again, there's questions. What did they do in the downturn? Did they take good advantage of it? What is their cash level? Why do they still have cash? Shouldn't they have been acquiring assets during the downturn? What kind of deals do they structure? It's a complicated business model. There's a million different ways to structure them, so there's a lot of questions to ask, but they certainly deserve some consideration. Now, right now, I would also say that there's some pretty interesting opportunities that are only available in the earlier stages of a new bull market. So the people in mining who bring together assets and companies and technical teams and management teams and create new opportunities, they've been planning for this new bull market for the last 5 years. They didn't just sit still. They were watching for assets that became available. They were watching for technical teams that needed something new to do. And so some of those plans got underway during the bear market, and quite a few of them are just being unveiled now. So one of the bear market opportunities, I'd say a good example was Newmarket, who we heard from yesterday. That's a technical team that took advantage of the downturn to create a new production company that's doing really well. Plans being unveiled now, Anfield Gold, that just happened at the end of last week. It's sort of developing quietly for a while, but basically there was an announcement that they're raising $25 million. And that was the unveiling, basically, of the fact that this is Ross Beaty's new gold vehicle. And the share price moved the way that it should for that piece of knowledge being added to the picture. So these kinds of opportunities are pretty interesting, and they're only available in this earlier stage of the bull market. The reason that they happen is because it takes a really long time to get a project from prospect to production, if it even gets there. But for the successful ones that do get through that whole trajectory, mining cycles are shorter than the time it takes to do that. That means that every asset goes through bear markets. Most assets, even fairly good ones, get very dusty or sometimes go backwards during the bear market. Not every project or team deserves a second chance, but because of that disjoint between how long it takes to get an asset through the process and how short mining cycles can often be, a lot of assets and teams do deserve another chance. So if you look around right now and you can see that there's new money, new partners, new people, new energy of some sort going in to revive what I would call a dusty but deserving asset, those are the kinds of opportunities that can really jump in these early stages of a bull market. And I have a few examples down there. There are others. You have to sort of have your ear to the ground to catch those ones. Then there's other commodities. Clearly, we're all in love with gold right now. That's fantastic. But we've heard from some companies this weekend who are exploring for other commodities, and rightfully so. Copper makes our world able to be the way that it is. Copper is how we electrify, and therefore in the developing world, as quality of life increases, that demands copper. So copper demand just keeps rising, and new supplies are present but limited, especially when it comes to scalable new deposits. Copper is also a very tight market. There's only ever a few 100,000 tons of excess or deficit in a 19 million ton market. It's always very tight. It's very reliant on specific places like Chile, where they've got water issues that could rear up in an ugly way. There's labor issues that could rear up in an ugly way. So I would say copper prices will strengthen over the medium term and could strengthen in the short term if there's some sort of supply disruption. Zinc. Everybody keeps waiting for zinc. I keep waiting for zinc. The 6-month chart for zinc, which is what you're looking at there, looks pretty fantastic. So that's great. The zinc story is absolutely one of major mines closing and production cutbacks against a dearth of new supply. And that dearth of new supply is probably more prominent for zinc than for anything else, because zinc has been an unloved commodity for like decades. So there just has not been very much zinc exploration. And so there's the supply deficit that's projected for the zinc market. Investors do understand that zinc's day is coming. We just keep waiting. But within that, I mean, Northern Shield we saw is getting some good attention. That's primarily, sorry, that's a nickel one. I clearly wasn't thinking when I put that on there. But Constantine's partner has been working, we're going to hear from Constantine in a minute, has been earning in on their project because of the zinc that's there primarily. So zinc is absolutely also deserving of a place in your portfolio. Lithium is one where there's real opportunity as long as you're very careful. So the supply-demand arguments for lithium are real. There's a supply crunch that is coming. If you just take personal electronics, industrial uses, and conservative assumptions for how much electric cars will increase lithium demand, you're looking at a tripling of the lithium market in a decade. There is not threefold lithium supply available unless new production comes online. So the lithium bubble that is happening is deserving because new supply is needed. Within that, realize that lithium is a hard industry to understand, and it's already a bubble. There's juniors piling in who are talking about lithium claims that they've made. And so their share prices will mirror the price of lithium with a little bit of extra, I don't know, enthusiasm thrown in. But there will be a few companies that create real value because they advance their projects actually towards production or near enough to production that one of the true lithium producers acquires them in order to be able to fill that real supply gap. So there's opportunity in lithium provided that you're careful. Uranium I could have talked about for my entire 20 minutes. I will try and just slam the story in quickly here. It takes time to recover from the types of shocks that have hit the uranium sector over the last 5-6 years. But there are now more reactors operating and in the pipeline, which means planned, proposed, and under construction, than there were before the Fukushima disaster. So the nuclear build-out is very significant, it's very real. It was slowed by Fukushima, but it was not stopped. And because of that build-out, demand is climbing and supply is not, because prices have been weak for too long. So within that, it's a market that has these contracting timelines. I expect a flood of new contracting to kick off at some point, I'm hoping in the fall, as utilities sort of race each other to finally sign new contracts to cover their needs that they haven't covered 3 years out, which is when that supply crunch really hits. And that contracting rush will support a higher price because producers will demand that, because current prices are insufficient to give them the money to build new mines. So as I said yesterday when I was asked for my favorite 5-year commodity, I said uranium, and I would stick to that. So in general, when you're looking at your portfolio and figuring out what to do over this exciting coming market, make sure that you diversify across stages of production, across business models, across commodities. Don't get too focused on just your favorite style of asset, stage of the game, whatever it might be. Also, take money off the table. If you're way up, take off your initial capital, reduce your cost base, whatever it is. If you don't, and then the stock goes back down, that's your fault. Do watch for opportunities to increase returns, whether it's a financing, a news event, a seasonality that might be able to lower your cost base. And yeah, keep it in context. New opportunities will continue. Those new bull market opportunities that I saw, they're very much happening right now. You're in the middle of it right now. So if you're watching right now, if you're in touch with your community, your network, your broker, you should hear about these. It's a really exciting time to be investing in mining. So get out there and keep your eyes open for all the different kinds of opportunities.